Students, Assalamu alaikum. I welcome you all. Today it is class 12th, subject economics, and this very chapter is problem of deficit demand and excess demand, and our today's topic is monetary policy. First, you know that what is monetary policy. Monetary policy is that policy of the government which corrects the situations of excess and deficit demand by regulating interest rate and availability of credit in the economy. When aggregate demand needs to be raised to correct deficit demand, cheap money policy is pursued. It aims at lowering the interest rate, the cost of credit, and increasing the availability of credit. On the other hand, when aggregate demand needs to be decreased to correct excess demand, their money policy is pursued. It aims at raising interest rate, the cost of credit, and reducing the availability of credit. Now we talk about the components of monetary policy. Components of monetary policy. Components of monetary policy. Following are the principal components or instruments of monetary policy. Along with each component, we are describing the way it is used to correct the situation of excess and deficit demand. Number one is repo rate. Repo rate. This repo rate is the rate at which the central bank lends money to the commercial banks to correct the situation of excess demand. Repo rate is increased as a follow-up action. The commercial banks raise the market rate of interest. So, this raises the demand for credit. Consequently, consumption expenditure and investment expenditure tend to rise, implying a rise in aggregate demand as required to correct deficit demand. And number two is open market operations. Open market operations. This open market operation it is the policy that focuses on increasing and decreasing the stock of liquidity or means or cash balances with the people through sale and purchase of securities by the central bank. When cash balances need to be reduced as during situations of excess demand, the central bank tries to sell securities. Consequently, aggregate demand is increased. Number three is CRR, cash reserve ratio. Cash reserve ratio. It refers to the ratio between cash reserves of the commercial banks with the central bank and its total deposits. Commercial banks are required to maintain minimum CRR as fixed by the central government. Central bank, from time to time. CRR is raised to correct situations of excess demand. A rise in CRR reduces the reserves of high-powered money with the commercial banks. In short, we can say that it releases more liquidity into the system. Availability of credit rises. Accordingly, aggregate demand tends to rise. Number four is SLR, statutory liquidity ratio. Statutory liquidity ratio This refers to the ratio between liquid assets and total deposits of the commercial banks. The commercial banks are required to maintain minimum SLR as fixed by the central bank from time to time. During situations of excess demand, SLR was raised with the view to squeezing liquidity. Or we can say both SLR and CRR are legally determined by the RBI and may therefore be called as legal reserve ratios. Number 5 is margin requirement. It refers to the minimum down payment that the borrowers are to make as a percentage of their total borrowing from the commercial banks. Margin requirement is raised to correct situations of excess demand. Higher margin requirement acts as a disincentive to borrow. According demand for credit is reduced, implying a cut in AD, or implying a raise in aggregate demand as desired to correct deficit demand. Number 6 is moral suasion. It refers to moral pressure on the commercial banks by the central bank to be liberal in lending during situations of deficit demand and to be selective in lending during situations of excess demand. And last one is credit rationing. Credit rationing. Credit rationing means loans according to prescribed limits of credit for different sectors of the economy, and it is introduced to correct situations of excess demand when availability of credit needs to be restricted. A rationing of credit is an instrument of their money policy. It is not required during situations of deficit demand when the banks are advised to pursue cheap money policy. This question now we sum up all the questions of this very chapter in my next lecture. Till then, thank you very much.